Welcome to the Med Favor Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Matt Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
Welcome back, everybody. We got a big guest today. We're joined by Alex Wright, partner and global wealth strategist at Apollo. He's joining us today to talk about what's going on in the world, his research piece from January, which I loved, one of my favorites this year. Can private markets be the alternative to lofty public market valuations? We'll put the link in the show notes. And if you subscribe to the Idea Farm, which is free, by the way, you would have read it when we sent it out in January. But if not, be sure to subscribe at theideafarm.com. Check out the show notes. Alex, welcome to the show.
Hey, Matt, thanks for having me. Really appreciate the opportunity to chat today.
So what do you do at Apollo? For those that don't know you or know what's going on, what's your role and how do you fit in? That's a big company over there, a lot of AUM.
So I've been here just about 15 years. I came over a long while ago and I was managing a number of our credit portfolios, CLOs, closed-end funds, direct lending BDC. And then about 6 years ago, Jim Zelter, the president, approached me with a new idea, which was to create a strategist role. So I did that on the institutional side for a fair amount of time. And then as we started moving more deeply into the wealth channel, they tapped me to move over and do the same thing. So life is a roadshow. I'm traditionally on the road 160 nights a year, interfacing with advisors and investors. So the title is Global Wealth Strategist, but really it's consultative, talking to folks about allocations and different ideas and how private markets could help them out.
That's a lot of nights on the road. I extend the same invitation to you as everyone else listening, which is if you find yourself in Manhattan Beach, we'll take you out for some tacos and a surf or a beer, whatever you prefer of those three things. But it's been as usual, it's been an exciting time in markets, geopolitics. Everyone's all kind of, I feel like, a little distracted with tariffs and what's going on with the political scene. But maybe zoom out for us. Talk to us a little bit about the macro picture today. You could talk about it. I feel like you guys were pretty spot on last fall talking about it in November. Maybe give us a quick overview, what you're thinking about, what you're seeing.
Yeah. So, high level, it's a lot different than what it was this past Friday. The news coming out over the weekend with reducing the tariffs on China has made a big difference. Our chief economist, Torsten Slok, is well followed. And I think the viewpoint that he had coming into the weekend was as high as a 90% chance of recession. So we were obviously very defensive. We had delevered our funds. Mark Rowan, our CEO, certainly was positioning us well in advance to be ready to hit the fat pitch, as they would call it, that comes a couple times every 10 years. And we did get a little bit of that in April. We actually deployed some $25 billion into the credit markets during that time period, kind of capturing those really good investment opportunities. With the change now, we're not out of the woods. Let's be clear, if we're still looking at 30% tariffs, certainly better. Probability of recession way down, call it 30%, if you will. But we do think we're going to see increases to inflation yet, some knock to GDP. So, like I say, we're still navigating through that. And we think if the message in January was to de-risk and sort of move into privates away from extended markets with the retracement from what we've seen both in the equity markets here and in the fixed income markets, we're still standing by that. We think it's a time to review, consolidate, and de-risk yet again, given the run-up, because we don't have clarity on where we're headed.
You snuck in a little comment there that I feel might be more impactful, but mention the word inflation and potentially higher. What does that mean to you? Does that mean 3%? Does that mean 5%? And what are some of the indicators or reasons you think that might be maybe a little higher?
Yeah, house view is like a plus upwards to, 1.5%, maybe even higher, depending upon how this all pushes through. So if we're at 2.4, you start adding that, you're neatly above 4 or close to it, which is going to clearly put the Fed in a tricky position. It's a stagflation shock, and it's still here, just not to the magnitude with the, very high tariffs on China, but it's still here. And traditionally, the monetary policymakers, if you will go after the inflation side of the stagflation and come back for the stag later. Certainly, the administration would love to see Powell move quickly on reducing rates. but I think they're going to wait and see what the actual data is as it comes in. But directionally, we think more inflation to come.
Particularly over 4%, it starts to get investors a little worried. The while we're still on the topic of tariffs, and we can leave them, I guess, at some point, it's always kind of hard to see. And I'm currently wearing a shirt of a company, Rails. Listeners, you may know, mentioned them before on the podcast, but they've done some manufacturing in China and trying to get some insight as to, boots on the ground sort of responses as to how they deal with this. And part of me thinks, like, part of the old school anchoring bias, 30% doesn't sound as bad as 140%. That sounds apocalyptic, almost impossible, but I imagine this is what everyone always is most curious about. Any way you guys see kind of how to think about game planning this for the rest of the year on that topic of tariffs before we kind of move on to the rest of the world?
Look, I think one thing that most are not talking about, because most are saying the consumer will just shoulder this with price increases. And I apologize to get wonky on the accounting side. I know this is more of a fun show than a...
Oh, no, people love the wonk. So go deep as you want.
The way I'm looking at this and hear people here is, what's the impact on working capital, right? For the first time now, the way the tariffs work is the importers have to pay the tariff within 3 to 5 business days of the goods hitting the dock. They didn't have that before. So that's chewing up working capital. You layer on the fact that, as we saw the GDP print most recently, the negative number was all driven by net export realities, which means that the inventory channels have been stuffed ahead of the tariffs, which also chews up working capital. So why does that matter? It matters because cash that would have been diverted to maybe spend on capital expenditures for expansion or hiring has been diverted into this working capital trap, if you will. That'll burn off over time. But then the knock-on question is, okay, well, how long does it take for a company to convert inventory to a product, to a sale, to a receivable, to cash? We did that analysis. It looks like S&P 500 companies about 62 days. Smaller companies, Russell 2000, let's say more like 82 days. Those will be elongated because they jacked up their inventory levels as well. So the question is, can these companies shoulder it? Many of the smaller companies fundamentally can't. And that's where you're seeing a lot of consternation and a lot of issues and challenges from small businesses. Now, if we think about like one requisite example, I was watching a news program that had a sole proprietor in the toy business, little shop, and she held up a panda bear, which was kind of interesting given the China tariff at the time. But nonetheless, she said, look, it retails for $49.99, subject to tariff. 30% or 125 or whatever they were at the peak, you'd have to list that for sale at an untenable level. Like no one's going to be buying a panda bear, at $80, $90, $100 plus. And I don't think that operator has the operating margins to shoulder it, meaning just cut their margins and eat some of that. So that becomes a lights out, close the door, lock it, and the business is cooked. So we're seeing that around the edges with many of these companies. The real question will be, what is the right tariff level for them to kind of survive that? That's a TBD. That's why we still think that there are headwinds and risk, even though the most acute, as you were saying, apocalyptic type numbers have been taken off the table. I think if the administration first came out with 30, people would be like, ooh, that's really high. Like, how are we going to digest that? But it feels better because you were coming from such a high number. So I think we need to see this kind of come through to determine what the potential impact is across the board.
You guys do some of my favorite graphics. It's very clean. It's very simple. And I love charts where you can just look at it and kind of come away from the conclusion just by eyeballing it. But I figured we'd start a little bit on public markets before we hop over to private, because as mentioned, I really love this piece you guys put out in January. Talk to us a little bit on your thoughts on public markets today here in springtime 2025, and then we'll go from there.
Let's start with equities, right? So over the last many years, investors had a choice. They could go to Europe, they could go to China, they could go to the US. And what we saw was a bit of a crowding trade, right? Everybody came to the US more, by and large, and everybody pushed into Mag 7. And if you isolate even inside Mag 7, NVIDIA on a standalone basis with $3 trillion in valuation exceeded basically every equity market in totality, but for maybe Japan. So you had a very crowded, narrow trade. That bubble was pricked a little bit earlier in the year, pre-tariff, right? You saw President Xi in China change some economic policy, some more quick-moving money went there. You saw a rally in Chinese equities. You saw it in European equities. And when the tariffs then were put upon it, you could see that drawdown happen pretty quickly. So the question had become at that point, did we go from like super American exceptionalism to just exceptionalism? And I think that's kind of part of the narrative that we've been kind of talking about here. And so you have the drawdown, but the retracement is a little curious because now you're at, let's call it a 22 PE, certainly higher than the norm. And yet you have a whole group of S&P 500 CEOs pulling guidance with no idea what comes next. So from a fundamental standpoint, it seems a little fragile. At the moment, we'll have to see, what earnings look like on a forward and so forth, what these working capital implications are. But for the market just to completely retrace and keep going, the question I think one needs to ask right now is, what is the equity risk premium that you are looking at on a forward 12-month? You already came back from the trough, and that's great. And if you held, perfect. But now what happens next? And as we look at the equity forecasters at each of the big banks, they're either side of 58, 59, some are a little bit higher. But when you have a risk-free rate, I call it 4.3%, you're basically on top of those numbers, maybe a little above. But it certainly doesn't feel like you're getting paid equity-like returns at the moment, and you have the uncertainty on top of that. And then the big question, okay, what happens in 90 days? And it's really not 90 days. That's only China because the other 90-day clock started a bit ago. So we think standing by it again, it's a good time to review, potentially consolidate, and de-risk your book, maybe even flip into income-oriented strategies for the time being to wait it out. On the public fixed income side, just to isolate that, you've had over 100 basis point movement in high yield spreads, from peak to trough back to, not a peak again, but getting closer. You have IG that gapped out to like 107 over treasuries. Now you're kind of back at upper 90s. It doesn't really matter. Either one of those numbers, even at the trough, was still inside of historic norms. And if we go back to January, when you referenced the piece that we put out, we were at 20 to 30-year tights. So here again, it becomes a question of, as you are building out on the risk curve, are you receiving the right risk premium? And if you're not, are there other things you could do? And the last point I'd make is on a 60-40 analysis. And again, most people are beyond that at this point. But through that lens, it's up, up or down 1-2% for the year. We've seen heavy correlation over the last 3 years, the highest that we've seen in decades. So I guess the takeaway is, what else can you do based upon those fact patterns? And that's where we kind of lead into private markets more generally as an option.
Let me jump in there because there's a couple comments that I think, listeners really need to let you sink in. And we'll post this in the show notes, this graph. But I mean, thinking about the fact that NVIDIA, one single stock, one single company, is bigger than the equity market cap of every single stock in Canada, in UK, in France, in Germany, in Italy, on and on. It feels so, it's like just one of those statistics that just hits you in the face. It's like, oh my gosh, that's incredible. And then second, which Alex mentioned, is there's a chart that shows, a lot of these public credit spreads near the historic lows. We're talking on high yield at the time. This was January. And again, these have moved, but 2, 5, 10%, the bottom decile of giving you juice relative to, history. That's an interesting menu. And then valuation on the broad stock market, which includes things like NVIDIA. It sounds a little scary when they say, we expect stocks to return three and change per year. Realize that's real returns over the next 3 years. So closer to 6-7%, but not 10, and certainly not 15, which I think is what most people expect at this point from the last 15 years, is 15% returns on and forever, always. So, all right. So that menu is somewhat limited, but we often tell people, say, look, you go to the grocery store, it's not just Raisin Bran and Wheaties. Like, you have hundreds of cereals or hundreds of choices now. And one of my favorite charts in all of investing is a chart you guys have. It's a slightly different variant. And these are all in the same piece, which is why I love this so much. But it's Exhibit 7, which is of the US firms with 100 million or more in revenue, so decent sized companies, the share of public and private companies in the US, 87% are private and 13% being public, which to me is like such a giant reason, and the main reason I like of private is that it's breadth. As a quant, you just got more choices. Like you got way more choices out there, and there's a lot of stock choices already. But anyway, talk to us about the kind of moving on from, the topic of this piece. Public, can privates be the answer?
Well, certainly the diversification is key, right? And that's where, the diversifying and de-risking commentary comes into play. And you're absolutely right. Those are the statistics. And then if you actually go across the pond, in Europe, it's an even higher percentage, up into the mid to high 90s. So you just fundamentally have had a reduction in the number of publicly traded companies. I think the number is something like down nearly 50% since 1996. So you are in a very narrow, concentrated trade on those public equities, whereas privates, it's just going to open up a much broader universe with the point that you're making. Now, the question becomes, well, how do you do that? Do you do it through debt, through equity, or what have you? And from our perspective, we think that debt with coupon-oriented payments, new vintage loans are quite attractive. We can get into that in a moment. But more generally speaking, when we look at who's using privates, right, there's an equal amount of capital held by individuals and institutions, about 150 trillion on either side of the equation. Institutions are probably in a 20 to 30 or higher percentile of using private markets for the reasons that we just cited. The diversification, you should drive alpha over a cycle, getting an excess return per unit of risk. But individuals within the global wealth arena, it sits actually at about 3%. So at the moment, people have been geared and trained to 60-40, to CUSIP, to publicly traded stock, but you're leaving behind nearly 90% of the investable universe. So we've made a concentrated effort to move in there and define and educate people with the idea of helping them diversify and get access to these types of opportunity sets to improve their overall performance.
When you think about private, you've had this conversation hundreds, if not thousands of times, I imagine. Your standard investment advisor or your highly educated individual, kind of this opportunity set that may or may not be, traditional allocators, but curious. What are their main hangups? Is it just education hurdle where they're like, it's complicated, too hard pile? Is it they're worried about fees? Is it they're worried about liquidity? And kind of where do you see, the best ways to kind of address that and have vehicles and opportunities they might work out for them?
Yeah, I think historically, much of the private market arena was very high minimum investment size, 5, 10 million. Much of it was in drawdown fund format, right? And so it would take multiple years to get the money in the ground, and then the realizations come, over the subsequent number of years. So that was kind of like a 6 to 12 year experience, with one investment thesis. I think part of the development of this has been the introduction of evergreen funds that allow people to come in as frequently as daily or monthly, and then provide liquidity, whether that be on quarterly basis or what have you. But it also in turn has lowered the minimums. We have some funds that are $2,500 minimum, as an example. Some are a little bit higher than that. But the reality is it really has allowed for multiple access points across different jurisdictions with these types of structures. And I think that is an attractive approach. And, there's a term that's used a lot, but I'll use it here. It's the democratization of access to private markets, right? As we think about it coldly, on the LP side, limited partner side of our business, on institutional, we manage money for pension systems, right? Police, teachers, state workers, corporations. Why is it that we wouldn't be able to offer that to people that are just in different occupations? But we had to create these different structures to allow these access points to develop. And I think that's what we've done a fairly good job on here in the last 3 or 4 years. So the adoption rate is increasing, but I would say access, the size, and liquidity are certainly things that people think about. And then I would say the other thing is, historically, some of the what I'll call alternative investments, which were more just hedge fund, PE, venture, or what have you, some of the performance disappointed. And what we've developed is more what I'll call professionalized private markets, where we're actually putting our own balance sheet capital to work in size and scale. So it's, in our view, really important for us to not just bring core competency to the table, but our own capital. And that stands, distinctly different than others within the marketplace as competitors, given that we're putting, serious amounts of capital, both at the firm level, but also partner level, side by side, same fund, same time, same pricing and terms. I think people get a lot of comfort from that, knowing that if we make a mistake, it's going to hurt us a lot more than them in many cases. As
you kind of have this conversation about private, and maybe we'll start with private equity and then kind of move over to private credit. Is there one that kind of seems to be the bigger interest that you think on the outside, non-traditional investors, so less pension funds, but more investment advisors, individuals? Is there one that is head and toes above the other or about the same?
I think there's interest in both. It addresses two different things, right? As we think about the application of privates and why and how do you use them, we don't view it through the lens of a bucket, okay? We look at it through the lens of replacement. So if you think about, go back to the 60-40, 60% equities in this basic example, we would look at some of the private market activities as a replacement to public equities, right? That could be a diversified private markets portfolio that includes a lot of private equity and other things. It could be private equity where we're buying companies, secondaries as yet another example. Arguably, some of the private credit funds could also be considered, but it would be a replacement. And the idea behind it would be, how do you drive alpha over a cycle, mute the volatility that we've seen so acutely most recently in public equities, and then diversify at the same time. The same is true on the credit side. So how do you use private credit to replace traditional investment grade or high yield exposure, right? It could be direct lending. I mean, we would certainly favor large cap, new vintage. It could be asset-backed finance. It could be forms of opportunistic credit. But all of these components really should be viewed through the lens of how do we replace portions of that 60-40 and on a combined basis to privates. And there's no magic number. It's definitely dependent upon an investment objective and suitability. But how do you get an investor to 20 to 40 to 50% on a diversified basis? So that's kind of how we think about that fundamentally. So it is balanced by way of demand. I would say, certainly private credit has been in vogue here, but it's balanced between, all these areas, including, frankly, private real estate and private infrastructure.
We've talked a lot about the global market portfolio over the years here on the podcast. And one of the slides, I believe this is from one of your coworkers, Torsten, and hopefully we can publish it. I think it's public, but it's got a nice slide where it's talking about public and private markets and the size, and says, I think it surprised a lot of people, but global fixed income, slightly bigger than global equities, but squish them together and they're up around 250, 300 trillion, somewhere in there, depending on what's going on in the world. But global private capital AUM, only 14 trillion, So on the scale, you would think that's got a little room. As much as people think in their heads, oh my God, these kings of the kingdom have all the assets, but reality is, compared to public, it's still I don't want to say an afterthought, rounding error, but still quite a bit smaller.
Yeah, no doubt. And look, I think there's plenty of runway ahead of us. The real question is, selection of manager is important. Typically, performance figures for public guys are measured off of an index comparative, and it's measured in basis points. Within privates, you're talking about it could be as wide as hundreds of basis points. And this is where, selection of manager really matters as it relates to what asset category as compared to, trying to pick the right mutual fund guy versus the index and so forth. So these are all, serious considerations as you think about privates as well.
Well, hang on private equity here for a minute, and just kind of talk about that in general. One of the opportunities, as we mentioned, was simply the breadth and the amount of choices. I was laughing. I was listening to a Patrick O'Shaughnessy podcast, chatting with a few professors about search funds and their students, and the opportunity set being these companies trading at 4 or 5 times. I was like, my God, 4 or 5 times. Now, granted, they're like pool cleaners probably, or some local neighborhood business, not quite NVIDIA, but it was just interesting to hear. As you look at the opportunity set today on private equity, is it comparable to public markets as far as valuations? There's a big challenge of a lot of these funds that have been doing this for a long time due to the lack of kind of IPOs, somewhat of lack of M&A. There's a lot of companies where these funds have been sitting on them for, 5, 10, 15 years, whatever it may be. What's the opportunity set in private equity look like today? How are you thinking about it?
Look, the reality is the multiples have come off of peak. Peak was kind of 12, 13 times cash flow. And there's different styles of private equity. I think that's one of the more important considerations, right? The growth private equity, which is not what we do. I'll refer to us in a moment, but the growth private equity is going to continue to be under some pressure. Part of this is a lot of the return, like upwards to 90% plus, had come from revenue growth and multiple expansion. Well, multiple expansion is kind of a yesterday thought, okay? Revenue growth, depending upon your viewpoint of tariffs and where we're headed economically, could be under pressure as well. And so when you look at the return streams, and this is part of the reason why you've seen slower realizations, there's a disconnect. What do I mean by that? If you look at the deals that were done 3 years ago, the equity contribution was, call it 30, maybe 40%. And the cost of capital was 6.5, okay, for your traditional leverage buyout. Today, in private credit land, it's a lot different, right? So now you're seeing 60% equity contribution and nearly twice the cost of debt. So this is just simple math. The growth folks that were making hay by way of cheap financing, a lot of leverage, those days are gone. So you're going to have to work harder. You're going to have to get on that hamster wheel and really create operating efficiencies, which many of the growth players just didn't have to rely on previously. Now, counter to growth, which I do think has that headwind or multiple headwinds, deep value, that's what we do here. That's what we've done for 35 years, actually, is purchase price matters. Okay, it's like, in the housing market, did you buy in 04 or 08? One guy's happy, one's not, going back to that time period. And the vast majority of the value creation from what we do comes from operating efficiencies and driving free cash flow to higher levels. Now, again, that sounds intuitive as we talk about private equity as a general comment, but I think, again, the cheap leverage and the momentum on multiple expansion really helped a lot of the growth players. The deep value, is a different concept. So again, you'll probably see more delay in realizations coming from those growth players because a lot of the headwinds still remain. But hopefully back half of the year, we'll see a little bit of daylight.
We very kind of briefly mentioned global equities, and that was really just a scale discussion relative to kind of the U.S. concentrated mega caps. When you talk about global opportunity set, how different does it look on global public versus global private equity? Is that as developed of a kind of industry and asset class setup for y'all and others, or is it a similar type of disconnect as far as valuations and opportunities? How do you think about it ex-US?
Yeah, so we don't have a hard and fast, like we're going to do 70-30, 80-20 North America to somewhere else. I mean, it tends to migrate close to that. And somebody asked me this actually just yesterday, what do I think about European equities relative to US, and could that be a better place to be? Based upon the valuations that we talked about and the lack of equity risk premium in the US S&P 500, one could say, well, maybe they could be higher. But then you come back to, again, the tariffs to say, what's the impact on those economies? It feels like the EU, at least for now, is digging in a little bit, not necessarily, moving into a situation like the UK with some kind of negotiated framework. So, what's the impact is going to be the bigger question. As far as valuation goes, I would say in the US, it's probably a bit higher to a degree, on private credit. Leverage, interestingly enough, tends to be a tick higher in Europe than in the US in many cases, but not so broad that it would like jump off the page, right? So I think it's going to be idiosyncratic to the industry and the underlying companies. And then, the question becomes yet again, are you a growth player in private equity or are you a deep value player? If you maintain your discipline, which is what we really adhere to on purchase price, I think it coalesces around, the multiples that I was referencing before, regardless of where you are from a geographic standpoint.
Well, it will be fun to watch. The, kind of one of the areas that I wanted to save some time for is really two topics. We haven't done a ton of episodes or deep dives into private credit. And I feel like everyone keeps hearing more and more about it and the opportunity. And it's a big space, 40 trillion or something on some of these assets in general. Maybe just give us a quick overview of where do you see the biggest opportunities, the different areas of private credit that would be most interesting to kind of building out a portfolio, and then we can kind of go from there.
Where we have been migrating toward over the last many years is actually large cap direct lending. Part of it is the size and scale of our own balance sheet and the third party funds that we have raised. We have a pretty substantial amount of capital. These will be companies north of 100 million of EBITDA. And actually, we've gone way up from there. We're averaging closer to 265 million of EBITDA size companies. So this is going to be right smack in the middle of what you would see the banks doing. We actually have partnered with banks. So we think as you look at the historic data, less defaults, higher recoveries, more financial flexibility at a minimum for those size companies, we think that's a better place to be at the moment. And that's the way we've skewed. Now, as you think about asset-backed finance, this is a completely different business. I call it chapter 2 of private credit. This is financing everyday life, right? If you flew in on a plane, we might have owned the plane and financed it. If you got into a fleet car, whether it be a rental car or what have you, we own one of the largest auto fleet leasing businesses in North America. Mortgages. Next day, you get up, you go to the gym, right? We securitize music royalty-oriented plays and other franchise plays. It could be a whole host of asset-backed inventory finance, equipment finance. This is a broad industry. We peg it at about a $20 trillion opportunity set. We've trafficked in it for 15 years. We've done some 300 billion of this type of financing. So it's really interesting risk-adjusted return, and a lot of it skews toward investment grade rating. So when we're thinking about, how do you de-risk, this is a logical area. Both areas are logical, but certainly asset-backed is something most individual investors haven't really encountered, particularly in the investment grade format. So again, it's a broad opportunity set that's being brought most recently within the last few years in these evergreen formats for investors to get access to. And look, the return streams, so you need to be more thoughtful and do your homework on the private credit managers. What do the portfolios actually have in them? Because look, frankly, over the last 3 years, if you threw a dart and hit any private credit manager, you're getting 10, 11, 12% return, nothing to see, just keep on doing it. I think that is becoming very much different by way of credit metrics, interest coverage, leverage on the vehicles. And you're starting to see it come through the economic realities.
As you look you mentioned the yields, the spreads, how they've been trading. How similar does it rhyme with the private and public? We mentioned earlier some of the high yield being at really slim spreads, but also I've seen, some other charts where y'all talk about private or public BDCs on VanEck or other kind of indices to look at. Is this something where, X amount of these, usually when you see the VIX blow out, you see, the spread being a pretty decent correlation. Maybe this one was so quick that it kind of didn't have long-term implications, but the private versus public, do they tend to rhyme, in your experience, and how has it played out so far this year?
They do decouple, right? So I think private, public, let's take a couple of concepts. Let's look at high yield versus private lending on the direct basis. So we saw in 22, 23, spreads widened to the widest I've ever seen in 30 years, kind of 650. Those came back into more normalized level, kind of 475, 5.25. With this most recent bout, they widened a touch. But if you think about the base rates where they are, you're still looking at nearly 10% unlevered return, which is quite handsome for first lien senior secured. High yield at 400 over, give or take. It just doesn't feel, the same, particularly given that high yield is unsecured debt down the capital structure. Okay, so that has to be weighed in to that. I would say, spread differential between high yield and bank loans, you're looking at 175 to 225 is a normalized range. You're still in that zip code, so to say. Now, then you go to private credit funds or business development companies, if you want to call them in that formal way, the publicly traded versus the perpetuals. Those are private. Okay. One trades like a stock. One is you come in at NAV. It's quite a sort of BDC 1.0 and 2.0, as they would say. So if you think about the public BDCs, that's an equity that you're buying. Don't make a mistake about that. It's attached to a credit portfolio, but you're not coming in and out at NAV. You're coming in at whatever the trading level is. And what we have seen, and why I was kind of shouting, be really careful with the public BDCs about 12 weeks ago, was the trading levels were very elevated. The group was trading at about a 101 to NAV, but you had players within that were trading at 116, 124. That's abnormally high. And so what happened in this drawdown period in April, you saw that whole group kind of collapse down to 0.84 of NAV. They've rebounded some. They're at 0.88. Now, why am I defining this for you? Because it had nothing to do with the credit portfolio, right? You didn't have defaults just jump out of the box. This was all flows. This was all sentiment. Now, you go over to the private perpetual BDCs, you enter at NAV. And when you come out quarterly, if you elect to take your money back, you come out at the NAV at that time. You're at the credit level. So you didn't see wild swings in price action because the NAV hasn't swung in any very material way. So those are different vehicles. Some of them also on the public side charge fees on the leverage. Obviously on the privates, that does not happen. So this is why I say you got to do your homework to understand what are the wrappers that you're putting the loans into. Is it public? Is it not? Are you coming in at NAV? What are the holdings looking like by way of defaults, paid in kind, the vintages? And I think this, discerning between that and in our view, de-risking going into newer vintage at lower loan to values. And again, older vintage 50 to 70 LTV, new vintage 39, big difference. Interest coverage ratio, new vintage 2.2, older vintage, 1.5 or below that. You inherently have more downside protection with the new vintage as a result of you're just coming in at a lower level. I look at it through the lens of housing and like a mortgage. Who would you rather be as a lender? Do you want to be the guy that, lent out 60, 70% loan to value on the house or 39? Who's in a better position as a lender? Well, it's very clear and obvious. It's the same concept, obviously different asset class. But these are some of the trends that we're seeing and some of the things that we're warning about as we're seeing some of this older stuff kind of percolate.
Sorry, you hit a funny bone moment for me when we bought our house a few years ago. Listeners may have heard the story, maybe not, but we were going through the dumbest process, which is getting a mortgage through a traditional bank. And I'm looking at you, Wells Fargo, and Wells Fargo go through this many month process. They're like, you guys are fine. And then at the end, they're like, actually, we're not giving you a mortgage. I was like, well, why not? They're like, you're a hedge fund manager. I'm like, I'm not a hedge fund manager. What are you talking about? We don't have any hedge funds. I'm like, can I explain what we actually do? And they're like, you're not allowed to talk to the people that came to the decision. I'm like, Google, you could literally just Google it. And I'm like, all right, fine. How about we just pay half the value of the house? We'll just increase our down payment. They're like, that actually doesn't matter. I'm like, that's the only thing that matters. I'm like, what are you talking about? I'm like, what is anyway, I feel like there's an opportunity, but I one of my favorite charts, and we'll have to do a follow-up episode on this because there's so many deep dives we could do in so many different areas, but just looking at just banks playing a smaller role with providers of credit. And this is non-financial corporate debt, but back when I was born, it was like half. And today it's like 20%. And there's some good follow-up charts that talk about all the different asset-based lending, direct lending, hybrid securitization, that we could probably spend entire episodes on each of those topics. I did want to hit one more thing before we got to let you go into the New York springtime. We haven't talked about infrastructure. So, just a couple minutes really overview of this opportunity. You wrote the global need to update aging infrastructure, which I feel like everyone knows, talked about forever, but it's still there. Is an 88 trillion funding gap by 2040. Walk us through the opportunity and kind of what's the best way to express that investment.
Yeah. So look, there's going to be any combination of, private deals, public-private deal. The number that you cited is so large. It's going to take, as they say, a village to accomplish it. And it's a vast consideration, right? If you think about traditional infrastructure, toll roads, airports, bridges, tunnels, all this and that, that's a substantial and meaningful part of this, but it's so far beyond that. It's kind of the new industrial renaissance, if you will, as it relates to this type of thing, like the build out of data centers to support AI and other activities is very, very significant. So it's going to be information highways. It's going to be these types of activities, but also energy transition across the board. It could be all different types of things. And even if you look at things along the lines of, nuclear and supporting the energy that's going to be needed to build out a lot of this infrastructure for AI and data centers and so forth, inevitably it's going to require a lot of capital. Now, there's a couple ways you could play it. You could play it on the debt side or the equity side, or frankly, both, depending upon the situation. We do both, whether it be in a drawdown fund or in an evergreen opportunity set, to allow investors yet again access to these types of opportunities. You should get through this activity inflation protection. So if you're concerned about inflation, this is kind of an interesting thing to consider adding. You can get income as well if you're doing more on the credit side than the equity side. But it's a pretty comprehensive asset class fundamentally with, it just seems like a mountain of capital that's going to be required here over the next, and it's not next year or just the year after. You're talking about, the next decade plus, where a lot of capital is going to have to come in to freshen it up, if you will.
Anytime you're talking, what is that? I can't even do the number of commas. Cuatro, cinco commas at this point, 88 trillion. Alex, this has been a lot of fun. We got one more question and then we'll let you go. You look back on your career, most memorable investment that you've been a part of. Now, this could be you personally. This could be you at Apollo or at a former employer. Anything come to mind? Good, bad, in between?
Well, it's funny. I remember, and today I was just addressing a graduating class of where I went for MBA school at Fordham. I was getting a little award and they wanted me to kind of reflect just like you asked me. And I remember I was in the middle of my valuation class during the MBA curriculum. And again, this is like 25 years ago. And we were a lender to a company, and the billionaire owner called and said, "Hey, we're going to refinance you and we're going to offer you $450,000 for your warrants. And here's the valuation report." So I was paging through it quickly while we were on the phone and told my MD at the time, buy me time. Let me look at this. And so he did, but I had to get back at 8 the next morning. And it was all wrong. And I redid it and it was like $1.25 million. So we settled on $1 million. And what was kind of cute about it was at that time at that bank, the team got 25% of the proceeds, which for a nothing-year-old kid was a good amount of money. But my boss teased, you just paid for the next generation of Wrights to go to Fordham Gabelli School of Business. My son actually did 20 years after that. So it was kind of an interesting one that tied that whole story together. So it wasn't the most profitable investment I've ever made in my career, but it was one that kind of stands out as a neat one. As we were trying to get hoodwinked, we did the work, we did the homework, as I've been mentioning throughout, and came to a different conclusion and answer.
That is the biggest takeaway of this entire podcast, y'all, is do the homework. In a world of TLDR, in a world of just reading the headline of the prospectus, I mean, God forbid the headline of even an article or a tweet, doing the homework gets you long past probably 95% of market participants out there. There's tweet read on the amount of time most people spend before buying a stock. Let's just say most people spend a lot more time researching TVs or probably even toothpaste at this point. Anyway, Alex, this has been a blessing. Thanks so much for joining us today.
Had a great time. Thanks so much. And maybe we'll do it again sometime.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.